In this module, we're talking about using financial statements and budgets. So let's start by talking about why this is important. Financial planning helps us to increase or grow our wealth. It provides us with financial security because now we have a plan for where we want to go and how we're going to get there. And so the whole idea of the plan then is to help us attain our financial goals. So the way the financial plans and the statements work together is what's shown on this graphic. So there are a number of activities that we go through in the course of financial planning, and that's shown in that first block on the left. So we evaluate and plan our major cash outlays, we manage our credit, we secure insurance, and we're going to talk about all of these things as the semester goes on. We establish savings and investment programs, manage our benefits, reduce our taxes, whether it's income taxes or estate taxes, and we plan for our retirement. So those are the elements of the planning process. And then in order to kind of facilitate that process, we have to monitor and control our income, our living expenses, our purchases, and our savings on a monthly basis. And so we do that through the use of budgets. And then the way that we review and analyze our results is by generating balance sheets and income and expense statements. So here's an example of a statement of financial position or a financial balance sheet at a given point in time for a theoretical couple, Jerry and Liz. So we see on the left-hand side they have their assets, the most liquid assets first, just as if we were creating a balance sheet for a corporation, and then their less liquid assets like stocks and bonds, and then real estate and personal property. So the more and more difficult it is to sell the item, the less liquid it is, or the more difficult it is to convert it into cash, which is basically what's happening when you sell an item. And then on the right hand side, also kind of in order of liquidity, but basically in order of how quickly it's due. So current liabilities first, and then long-term debts second. So the left-hand side has to equal the right-hand side, or else our balance sheet is out of balance. So our assets have to equal our liabilities. And so the difference between, or what makes it balance, the difference between our assets and our liabilities is the net worth. So I guess I misspoke. Assets don't necessarily have to equal liabilities, but the left-hand side does have to equal the right-hand side, because what we're adding to the right-hand side is net worth. And so the way we figure out our net worth is we take the total assets and subtract out the liabilities. And unfortunately, net worth could be negative or positive, but in this case, it's positive. So that's exactly what we're showing here in this balance sheet equation, that the left-hand side equals the right-hand side, meaning total assets equals total liabilities plus net worth. So assets are the things that you own. So these are the four categories that we just saw. The liquid assets like cash or short-term investments, and then investments that we acquire to earn a return, so stocks, bonds, mutual fund. Real property is property that you can't move, like land or a house. And then personal property is stuff that is tangible but is movable, like furnishings, furniture, electronics, cars, boats, I guess. And then back on the right-hand side with the liabilities, we classify our liabilities by maturity. So as I mentioned earlier, when they're due. So current or short-term, that classification are items that are due within a year. Long-term are items that are due in more than a year. And then our net worth, again, is the total assets minus liabilities. If our net worth is positive, then we're solvent. We're in good shape. If it's negative, we've got some work to do. We're insolvent. So what's the median net worth? So once you figure all this out, how do you know how you stack up against the rest of the country? Well, the median net worth, so assets minus liabilities, is $71,000, but it's much lower if you're under 35, because under 35 you're just getting started. So if you're under 35, the median is about $3,700, and so that median net worth grows as we get older. That makes sense because we're earning more and we're saving more over time. Then the income and expense statement measures financial performance over a given period of time. So it's the income or cash that's coming in less the expenses or cash that's going out, and that would result in a cash surplus or a deficit if we've got more going out than we have coming in. So seen another way, in an equation, our income and expense statement is total income minus total expenses gives us that cash surplus or cash deficit. So cash coming in would come from wages and salaries, bonuses, commissions, interest, dividends, any type of reason why you have money coming in. So even gifts or tax refunds would be counted here. Money going out would be living expenses, rent, utilities, food, insurance, tax payments, federal, state, or local. Asset purchases, when you buy a car, you buy furniture, you buy those assets that we talked about on the balance sheet, or other payments for recreation and entertainment, any other money that you've got going out. And so some of these expenses or this cash going out is contractual, maybe installment loans, fixed payments for rent or mortgage or cable, things that basically don't change every month. And then the variable, you can change that. So your credit card payments, your food expenses. So those are things that you can adjust if need be. So the way that you prepare the income and the expense statement is that you record your income from all sources and then categorize them in a way that's meaningful for you, and subtract those the total expenses that you've categorized from your total income to get that cash surplus or deficit. So where do most people spend their cash? The biggest chunk typically goes towards housing, and then transportation and food. And then after that, it varies a little bit, but you can see what the major categories are.